All right, I think we're live. Good afternoon, everybody. I hope you're all doing very well today, having a great weekend. And, we're finally getting back to some California weather this week. This last week, it was like in the high 50s, low 60s. And I was talking to clients all throughout kind of the Midwest, but in the northern side, up in Ohio, Chicago, and they were having a beautiful week last week. So I feel like they stole our California weather, but we got it back this week. So it's quite beautiful. And I want to thank you all for tuning in today. What I want to, well, I want to first of all thank you for taking the time to respond to my question yesterday. I try to think of things, or I try to look at comments to see what's on people's minds. But I think sometimes it's best for me just to reach out and ask the question to see what's on your mind, because that's my ultimate goal here, is to try to answer your questions, provide you value, and help you really answer the questions you're looking for as you're trying to plan your next steps here into retirement. So by far, the biggest question that came in, was, how to minimize taxes on withdrawals. Okay. So the challenge here is this is a big subject, right? That is one of the challenges. And I'll be honest with you. When I looked through the questions, there's over 100 responses on this post. About 85 or 90% of you really need to get an advisor, right? The questions that you're asking are relatively on the technical side. And there's a lot of opportunity for mistakes, when it comes to distribution strategies, when it comes to planning for taxes, when it comes to creating a comprehensive strategy, when you're putting together all your different accounts, all of your different investments, all your different income sources to put an optimal plan together for you, right? And I know a lot of people really want to just do things on their own. But to be honest with you, the questions I saw, it was pretty obvious that a good percentage of you could really use a good qualified financial advisor, right? So I would highly recommend that you take that seriously. And obviously we offer services if you want help, but making sure you get somebody who is really qualified to help you with these questions. It's going to be an investment for you. Most likely, it's most likely not going to be a cost, right? It might be a cost up front because you have to write a check up front to get the advice. But when you're looking at numbers in the hundreds of thousands, if not millions of dollars that most of you have, put aside, at least a few $100,000, it could be significant, the amount of tax savings, the amount of money you can actually keep by getting a well-designed retirement income and distribution strategy. Okay. So I just want to say that as we're, getting all logged in here. So for those of you that are joining us, I want to thank you. If you have questions along the way, please put those in the comment box, and I'll do my best to address those either along the way or, also at the end of what we're talking about here. So today, there's a lot of technical information I can share about designing a well-planned retirement distribution strategy, right? And minimizing taxes. The challenge is, to be honest, everybody's situation is going to be a little bit unique, right? Because maybe you have, a lot of capital gains in the stocks or funds that you own. Maybe someone else doesn't have any capital gain. Maybe you have the majority of your money in a pre-tax account like an IRA or 401k or 403b. Maybe somebody else has a majority of their money in a taxable brokerage account that's not in the retirement account. Maybe some of you have multiple types of accounts where you have Roth accounts, traditional accounts, and brokerage. Some of you may have zero outside of your 401k. So this is where it gets a little bit tough to give you, okay, here's step 1, 2, 3 of what you need to do, because you really do need to look at your personal situation, take into account all the variables, and then put those together along with other choices like Social Security timing, pension timing. If you have annuities, looking at when you're going to take your annuities, those type of things all need to be considered when it comes to minimizing taxes on your withdrawal strategy. Okay, but that being said, I'm going to do my best to give you an example here in a case study and help you visually see what it could look like as far as designing a income strategy for you or withdrawal strategy for you. So hope you find this interesting and hope you find it valuable. For those that don't know me and you're new in the group maybe here, my name is Jason Hamilton. I'm a certified financial planner and a chartered retirement planning counselor. I'm also the founder of Keep It Simple Financial Planning. You can find us at keepitsimplefinancial.com. And we specialize in helping clients create their plan to retire with confidence. So we do the technical planning work, tax planning, things like that. We also do investment management. We'll provide the whole comprehensive services as well, if that's what you like to there too. So, but I want to come in here and give you some insight here and some kind of a way to look at things and kind of how I think about things when it comes to layering your strategy. So I use layering as the word in particular because there's really different levels you need to go down, right, when it comes to actually creating your plan. So you're going to start at one level, and then, which is kind of looking at the overall plan. And that's what we're going to talk about today. And then we'll have to go down a second level when it comes to actually making the distributions, right? So today we're going to talk about the high level of, what it would look like. We're going to talk about Roth conversions, including those in there as a potential part of your plan. But when it comes to actually looking at your accounts, inside the accounts, you're going to have different funds in the different accounts. So then we would have to look at what funds are we going to sell, how are we going to rebalance the account, what sort of allocation do we want to keep to fund our strategy. So there's a lot more things that go into this, but I'm going to keep a relatively high level today. And I would say generally, I wouldn't say simple, but I would say relatively high level. So hopefully you find this interesting and useful, and I'd love to hear your feedback as well. So if you watch this and there's things that you think I could have done better, please drop them in the comments. I'm happy to take that feedback and implement them for the next workshop. So I think this subject is worth spending a few workshops on. So I called this one part 1. I don't know how many parts we'll have, but we'll dig into some of the stuff over the weeks. And we'll start with this case study. And then, I'm actually interested if anybody is interested in having their particular situation used as a case study, right? So if you are interested in having your particular situation used, I would anonymize, all your personal information. I wouldn't use your name or anything like that. But if you have a situation where you have pension, Social Security, different types of accounts, maybe I can use that as a case study as well, and we can talk about that. But I just made up one for today. So hopefully you find this useful, and we will get going here. Hey, Grace, welcome. Rebecca, welcome. Great to see you guys here. So let me start here, first of all, before we jump in. I have to make this very clear, okay? This should not be seen as investment advice, tax advice, any sort of individual advice for you personally, okay? This is general use information. It's here for entertainment purposes, okay? So that's what we're going to be talking about today, and I have to let you know that, okay? All right, so where to start? Okay, where to start? So what I'm going to start with here is kind of an overview of the overall client situation. And I'll start with the facts of the situation, and then we're going to dive in, okay? So some of this is going to be a little smaller. So as I mentioned in my previous post, you might want to turn on your iPad or pull out your laptop or something like that, because some of this might be hard to see on your phone. But ideally, you can see this in a way that you can follow along, okay? All right, so in this case, this is a pretty typical client situation, okay? Your numbers may be different, but I have a feeling maybe they're not that far off. So in this case, we're going to look at the tax allocation. Okay, this is where we're going to start with this particular case. So you've probably heard before of investment diversification, right? Having stocks and bonds, having U.S. stocks, international stocks, emerging market stocks, right? Diversification. Maybe you have some real estate. Maybe you have some other hard assets like gold or something like that in your portfolio. Cash is an asset class. So there's going to be diversified asset classes within these three categories, but when you're looking at tax allocation, there's really three main buckets, you could say, when it comes to tax allocation. And so a lot of people don't have very good tax allocation. They might have great investment diversification, but they don't have great tax diversification, okay? So what do I mean by that? So in this case, this particular client has $1 million in tax-deferred assets, okay? So tax-deferred assets would be 401ks, 403bs, traditional IRAs, TSP, okay? Those type of accounts, right? And then they have $100,000 in tax-free assets, okay? So this would be Roth accounts, for example, right? So Roth IRAs, Roth 401ks, that type of thing. And then in this case, they have $220,000 in taxable assets. So this is a combination of brokerage accounts and cash. So non-retirement accounts. And a lot of times people get this confused because, what I call tax deferred, you may be thinking taxable because like in your 401k, every time you want to take money out, it's taxable, right? In that case. But technically, these are the three buckets. And this is how we're going to define them for our example here and cover with you today. So 401ks, 403bs, traditional IRAs, Roth IRAs, Roth 401ks, and then cash and brokerage accounts. So standard, mutual funds, ETF stocks that might be outside of retirement. Okay. So in this case, the client has a little bit of tax diversification, which is good. Like this is not a bad thing right here. this tells me we have some opportunities here and some options when it comes to withdrawing from our accounts. So the main question today is, how do we keep our taxes as low as possible, on a withdrawal? So again, very deep question, but we're going to start here with a certain case. And what I want to put in as a caveat and as a side note is, we can lower taxes, okay, in one particular year. But what I want you to consider is lowering taxes today may not be the best thing, okay? We may want to increase taxes today so that later we have lower taxes, right? So later in retirement, if we can make your later years in retirement have much lower taxes, then it might make sense to actually raise taxes for today, right? So it's kind of the opposite of what our particular training is on. But this is actually really something important to think about. And we're going to talk about that today because the majority of you are going to be more active early in retirement than you're going to be later in retirement. So let's say, for example, we never, used any of this money in this tax deferred account. Well, this money is going to continue to grow. And then what's going to happen is these accounts now have a required minimum distribution that's going to start when you're 72 years old. Okay. So it's called your RMD. So any pre-tax account like this is going to have a required minimum distribution. So, you really want to be planning on making sure that not only you're keeping taxes lower today, but also planning for those later years in retirement, because when you're in early retirement, you have a lot more options when it comes to tax planning versus later in retirement when you've already turned on all your pensions, you've turned on all your Social Securities. You don't have a lot of options when it comes to tax planning. It's kind of like you basically get stuck at that point. Not always, but a lot of times that would be the case. Lois asked the question, which would be an annuity? So Lois, that would depend how your annuity is held. You can have an annuity in any one of these three buckets. I generally don't recommend having annuities in tax-free. So if you have a Roth IRA, an annuity in there is probably the worst place to keep it. The first best place is somewhere between taxable or tax deferred, depending. Most people have tax deferred annuities. I don't really think that makes a lot of sense generally because if you're going to have an annuity has tax deferral already built in. So you generally want to use taxable money for annuities and keep annuities out of your IRAs. But there are certain circumstances where it can make sense. But I'm going to just leave it at that for now. Okay. So this is what we're looking at in this case. Okay. Client has about 1.32 million and they have three buckets here. High majority in pre-tax, a little bit of money in Roth accounts, and then a little bit of money here in taxable accounts, comparatively, percentage-wise, right? So that's where we're going to start. Okay, let's talk about some facts here of the client profile, okay? So primary client is 63 years old, okay? They're currently 63, and a co-client is currently 60, okay? So call this what you want, husband and wife, whatever you want to call it. So primary client 63, co-client at 60. The client's goals are basically to retire right now, okay? So they want to retire now with the primary client 63, the co-client is 60. Their monthly expense expected in retirement is about $4,000, okay? So this is what we're going to use for retirement expenses. We've already also allocated for healthcare, about $10,000 total for each, for the total of the couples per year. And then we also are going to have some buckets set aside for potential long-term care costs in the future. So that's all built into this already. But our general retirement expenses are going to be about $4,000 per month, okay? So pretty typical case. This is pretty common, right? So where I want to start here is kind of taking a look into the future for this client and to see what things may look like if we don't do any sort of tax planning, okay? So for this particular client, what you can see here is a little bit in the future, okay? So this particular client in the future, if we don't do anything with their pre-tax account, is going to have a distribution here from their 401k of an RMD at 63 of at least $63,000, okay? So that's something I want you to think about now, and we'll come back to this in a minute. Another thing to consider is Social Security, okay? So our primary client, right now, we have them set to take Social Security at 70, okay? At full retirement age, you're expecting $2,500, so we can look at some different numbers here. The secondary client, the co-client, we have them currently planning to take Social Security at 62, and their benefit is expected to be, about $2,000. Okay, so this is where we're going to start. So it's kind of a lot of information, so just bear with me here as we get through some of this. But when it comes to taxes, this is what I generally start with clients, is to pull up a tax map. So we want to look at, what the client's taxes are expected to look like in the future. Okay, so hopefully this is big enough for you to see. So in this client's case, as you can see, early on, depending on how we withdraw their funds, they're not expected to have too much in taxes here. Okay, a little bit later, we're going to have a spike in taxes, and then once we hit 72, this is where the RMDs are going to kick in, and we're basically going to have a taxes that are up here in this high percentage all the way until the end of time, basically, right? And then right here, we'll see this dip. This is where the first client, the older client, passes away, right? So then the expenses go down for a bit here. But then once we get rid of, when you pass away, when one spouse passes away, you do get to keep the married filing jointly tax bracket for, I think it's 2 years total, the year they pass away and the year after. But then after that, whoever's remaining is going to have a big spike because they're going to go to single tax rates, okay? So this is something we've talked about before here. So whoever's left over potentially could have a big spike in taxes after the first person passes away. So we really want to be thinking ahead about taxes. And I know it seems like a long time away, but what we're really trying to take advantage of is this big dip here, okay? So when I see a case like this, and we have a big dip in client, expected taxes, this opens up an opportunity for us to consider things like looking at Roth conversions. Okay, that is something that's going to be potential for this particular client. Okay, so this is where things can change a bit depending on when we take Social Security. So let's go back for a second, and let's say if we were to take our, we'll leave it at this for now. We'll go back in a second. So what we're talking about right now is take advantage of this area here. Okay. So if we were to do nothing, this is what our tax situation would look like, okay? We would have low taxes for the early years, but then once we hit 72, boom, now we're having, $83,000 of income, and eventually over time, we're going to be up to in the neighborhood of close to $200,000 in income that we'd be paying taxes on, right? So that puts you solidly in the, 22 today, it will be most likely 25% bracket in the future. So in the future, you can expect to pay, 10s, 20s plus or more thousands of dollars in the future, potentially, okay? The other thing to consider is there's a lot of you that may have money left over, okay? You may have money left over when you pass away, and you may leave an inheritance to your children. If you remember, we've talked about this again many times, but January 1st of 2020, the CARES Act passed, okay? And the CARES Act had some interesting things that had changed. So as you may know, required minimum distributions have gone from 70 and a half now to 72 years old, okay? That was a good change. Another change that's happened is what happens to your accounts, your IRA accounts, I should say, that get passed on once you pass away, and anybody that's a non-spouse beneficiary inherits your accounts, okay? So before, whoever inherited your accounts were able to take distributions over their lifetime. Now they have to distribute that whole account within 10 years, okay? So in this case, if we don't do anything here, this particular client is expected to end up with about $3 million at the end of their plan. And out of that, about 34.6% is going to be tax deferred. So in this case, it'd be $1 million. So if you had to leave money behind to your kids, and they inherited just over $1 million, and they had to add that to their income over 10 years, and let's say they're still working, they're in their 40s, 50s, or 60s, it's pretty reasonable to say that 30, 40, or maybe 50% of this money is just going to go to taxes, because they're going to be adding this on top of their current income. Okay, and if they're already earning an income in their highest earning years, there could be a good chunk of this money that goes away. So before we get into this, let's take one step back and let's talk about tax brackets, okay? Because I think maybe a lot of people don't really understand tax brackets, and this is actually something really important, okay? All right, so if you like this form that I'm using here, this 2020 important numbers, I might offer this as a download. If you guys want this, just let me know, and I might offer this as a download. You can download it and have this for yourself. This is only good for a little bit longer because obviously it's 2020, and 2021 is going to come soon, but we'll get to that. I can probably do the new one once that one comes out. All right. So one thing we need to understand, okay, is tax brackets. So a lot of people ask me, should I be putting more money in Roth today? So let's say you're working currently, okay, and you want to have more money in Roth, and we're going to talk about Roth conversions a little bit. But everybody's like, says, oh, I wish I had more money in Roth. I wish I had more money in Roth. Well, what you have to remember is that when you're putting money into a Roth account while you're still working and earning an income, you're going to be putting money into that Roth account at your highest tax bracket, right? Because you're going to be putting money in basically off the top of your current income stream. Whereas after retirement, if you were to be looking at something like doing a partial Roth conversion or converting a little bit of money from your pre-tax account, like your IRA or 401k, over to a Roth after retirement, you're going to be starting from the bottom up. Okay, so it's a completely different thing. So let's take it. What does that really mean? Okay, what does that really mean? Let's talk about that. So first of all, okay, when you're filing taxes, if you are single, okay, if you're single and you have no other income, well, let's just say if you're single, the first $12,400 of your income, that's the new standard deduction as of the TCJA, the Tax Cut and Jobs Act that was passed in 2016 by the Trump administration. They changed our standard deductions to just having, to being much higher, basically. Okay, and this helped out about 90% of people. There is 10% of people that this did hurt, and it's mostly in the higher cost of living states when it comes to housing, because they got limited as well on their housing deduction, their SALT deduction, sales and local tax. But for most people, this helped them out. So if you're single, you automatically get to pay zero tax on the first $12,400, and if you're married, you're going to pay zero tax on the first $24,800, and for next year it's going to go to $25,000. Okay. So after these amounts come in, then what I want you to start understanding is that the U.S. is on a progressive tax system. Okay, it's progressive. So what that means is the lower your income, the less tax you pay. So like I mentioned before, the first $12,400 if you're single, you're going to pay zero, and then as a single person, the next zero to, I should say $1, but the next $1 to $9,875, you're going to pay 10% of this amount to your taxes, okay? And if you're filing jointly, the first $24,800 is zero, and then the next $1 to $19,750 is going to be taxed at 10%, okay? So the reason I'm bringing this up is very important because we need to understand, if we're talking about planning in retirement, so after you stop working, and we're going to talk about Roth conversions in a moment. If you're putting money into a Roth while you're working, and let's say you're earning, and you're a married couple, you're earning about $100,000 a year, well, you're going to have to pay 22% tax on that money first before it goes into your Roth account. Whereas after you retire, let's say we wanted to put $10,000 in and you had no income. Well, we may be able to convert over and pay 0% tax on that first amount of your conversion. So this is something to consider, okay? But back to our progressive tax brackets here. So we talked about the 10,000 bracket, the 12% bracket, okay? The 10% bracket, not the 10,000 bracket. Well, I guess technically it's 10,000 here, but the 10% bracket, okay? Then once you get past these numbers, from 19,751 to 80,250 as a married filing joint type of household, you're going to pay 12% on that amount of money that's going to go to taxes, okay? And for a single person, 9,875 to 40,125, and so forth. The next bracket is 22, so from 80,250 to 171.50 as a joint filer, and from 40,125 to 85,525 as a single filer. You're going to be in what's called the 22% bracket. So that means the next dollar you earn above these amounts is going to be taxed at 22%, okay? So there are plenty of people in the 22% bracket, but it does not mean you pay 22% of all your money to taxes. Your effective rate is probably going to be more in the neighborhood of maybe 8 to 12%, something like that, depending on how much you earn. So we have to understand this first, the progression of the different tax brackets, how you pay more taxes as you go up. Okay, so this is why when you need to make a decision of where you're going to be saving your money and putting your money that you're putting away for retirement, Roth accounts are great. But if you're making, let's say you're married and you're making $200,000 today, and 24% of everything you earn is going to have to get paid first before you put it to a Roth account. Whereas after you retire, we're going to be starting at zero. We might be able to convert 24,000 over potentially even at $0 the first year, right? So these are things. Let me pause here and let me make sure this makes sense. So can I get some feedback here from you guys in the comments? Is everything making sense so far about how the progressive tax brackets work and the difference between contributing to something like a Roth account pre-retirement versus after retirement? We're going to be starting at the 0% bracket, which is here essentially. And then we're going to be progressing up these brackets here, depending how much we convert down the road. Okay. So if there's any confusion on this, just put a comment in and I'll do my best to clarify. But this is something I want you to understand first, okay, before we get too deep down the road here. And then the second thing we need to look at as well, when we're looking at retirement income strategy and taxation, is considering our capital gains rates. Okay, so our long-term capital gains rates. Okay, because if we have money that is in a brokerage account, okay, or it's just stocks, okay, so outside of retirement. So let's say you have stocks, bonds, mutual funds, or let's just say stocks and mutual funds. Bonds are taxed differently. But if we have stocks and mutual funds that are stock mutual funds, as long as you own those funds or those stocks for at least 12 months and a day, right? So as it says here, rates on qualified dividends held 12 months based on taxable income. If your income, your adjusted gross income, is less than $80,000 as a joint filer or less than $40,000 as a single filer, you will actually pay the 0% on any of those gains. Okay, so as we're looking to fund your retirement, and let's say we want to use some of your brokerage account, if we're making less than $80,000 as a joint couple, you're going to pay zero tax on any of that money that we sell. So this is where it starts to get a little more technical, a little more complicated. It's not just so straightforward on really keeping our taxes low in retirement, because sure, it might be great to take some money out of our pre-tax IRA at a 0% bracket, but if we take out too much, we may go over $80,000, and then now our brokerage account, we have to pay 15% on that. So it gets a little bit technical, and I'm trying to keep this simple, but this is really what you have to deal with and what you have to plan for when you're putting together a tax efficient retirement distribution strategy. This is why I'm saying the questions you guys asked in that comment, I could tell most of you need a financial advisor. Okay, so consider that. But so we want to look as well at where we're going to be at from a long-term capital gains bracket, and I forgot to pay any capital gains for any stocks or that we've owned less than a year. If you have a gain on those and you sell them, you're going to pay actually your full tax rate. Okay, so whatever your full tax rate is, that's what you're going to pay on that. But if you hold them for at least 12 months in a day or more, then you will qualify for long-term capital gains rate. So we always want to do that as much as we can. Okay, so now we talked about progressive income tax brackets. I'm going to switch back here to our distribution discussion. Okay, so let's go back to here to our distribution discussion. All right, so in this case, without any sort of tax planning, without any Roth conversion strategies, this particular client is going to end up with about 18% of their money tax-free. Okay, so what does that look like from a balance perspective? Let's see here. Okay, so if they don't do any planning, kind of at the end of their plan here, let's say, around 90 or so, that $100,000 will turn into about $477. The tax-deferred money, which is about $1 million today, after they spend everything, will be about 1.5 because they'll be spending over time. And then their taxable account balance will be about 1.37, which that whole amount of money you may have to pay capital gains on, throughout the years if your income's too high. So this is what it would look like. And the big reason why the tax deferred looks so small and the taxable looks so big is because the required minimum distributions, those had to be paid out every year, and those kicked out, and those went into a taxable account basically because this client just didn't spend the money. they only needed $4,000 a month to be comfortable. So again, everybody's case is going to be a little different, but this is, again, where we're going to start here, okay? So now we're going to look at a couple things, okay? So now we're going to look at potentially, what it would look like if we did some Roth conversions for this particular client. So let's say we converted this client up to a 12% bracket, okay? Where is that? Not showing up. Let's see. For some reason, it's not showing up here. There we go. Okay. So if we start converting for this client and we decide that the 12% bracket is the right case or the right bracket for this client, this is what their tax map is going to look like. So let me just go back for a second. This was our previous map, right? They're going to pay basically very low taxes early, but then once they hit 72, so if you can see here, this is the primary client turning 72. Now their RMDs are going to kick in, and then basically forever, they're going to have, $100,000+ of income they're going to pay taxes on all the way through, okay, if we don't do any conversions, right? If we do conversions, they're going to have more of a early taxation, okay? But as we get to right about here, right about 83 in this particular case, once we hit 84 for the primary client, remember the other client's only 80, now our taxes are going to go to 0, okay? They're going to go to 0 forever. And so what does that mean on the long term? On the long term, we've now gone from a 18% tax-free portfolio, so 18% Roth, to a 100% Roth portfolio. Not only that, because of all the taxes we saved over the years by converting earlier and then letting that money grow forever tax-free versus paying taxes along the way and our taxable brokerage of the money that's getting kicked out to from our RMDs, we've added, what does it say here? An expected almost $252,000 more in tax-adjusted wealth to this particular client's portfolio. So in this case, we're adding about $250,000 more to their portfolio. As it says here, this is tax-adjusted wealth, so after-tax wealth. And we're going to go from an 18% tax-free to a 100% tax-free, okay? So if we're looking at passing on this money, in this case, we're going to pass on the whole $3 million balance to our heirs 100% tax-free. In comparison, if we didn't do any conversions, we'd have about $500,000 tax-free. That would have to be taken out in 10 years, but then the tax deferred is $1.4 million. Okay, so that all has to come out in 10 years. So that's going to be an extra $1.4 million of income over a decade for whoever inherits it. And then you're going to have your taxable money on top of that, the 1.4, which is going to be in brokerage accounts, which is going to be spitting out capital gains tax every single year. And if we have the tax deferred money, 1.4 million coming out over 10 years, well, pretty much we know for a fact we're going to be over our capital gains exemption. And so we know we're going to have to pay not only our full tax rate on the distributions from our tax deferred, we're also going to have to pay 15, maybe even 20% on our taxable money, okay? So let me add something on top of that, just to add a little bit more pain. We'll call this twisting the knife here. If we have something like, the Biden tax plan, Biden wants to remove the ability to keep capital gains rates so low once you're above a certain income, okay? So you may lose the 15% capital gains rate. And so let's say our capital gains rate goes to our earned income. Well, we could be paying, 30 or 40 or 50% on all of our taxable and all of our tax deferred. And in this case, we'd only have about 523 if we didn't do any conversions that would be in tax-free. Alternatively, we would pay taxes early in this case, but by the end of our plan, we're going to be passing on a 100% tax-free portfolio that's all in Roth accounts, right? So this could be a very, very positive situation for your legacy and a much simpler estate to transfer than dealing with what we'd be dealing with over here, okay? So I'm hoping this makes sense, and I hope you're staying with me here, okay? So that's if we convert to the 12% bracket, right? Some people, in this case, it would take us till about 83 for these clients to convert everything to Roth, and so it would take us to 83 to convert everything. Let's look at a schedule, what that might look like, okay? So here's an example of this schedule. What we're looking at here is we're going to have the year in this column. We're going to have the client's ages, so primary 64 in 2021, secondary The co-client is 61. We're looking at what the conversion amount would be here, okay? We're looking how much we would need to use for income to cover not only the living expenses, but also the taxes on this conversion. But what we'd see here is we would convert over about $100,000, $96,000 from tax deferred, and we would add it to our tax-free balance here. So if you remember, we had $100,000 in tax-free, and we had about $200,000 in taxable. So we live off our taxable a little bit, and then we would add to our tax-free account. So this is our Roth account building up here, okay? So by the time this first client hit their required distributions at 72 here, as you can see in 2029, we would have moved over to have a pretty darn good tax diversification, right? So that's what we talked about at the beginning here. So now we have about, let's call it about 40% or so of our tax, of our investments in tax deferred, and we have about 60% over here in tax free. So this is beautiful, okay? So let's go back for a second and take away our conversion and just kind of compare for a second. So if we take away our conversion and we compare, okay? So at 72 for the same year for this client, so instead of having a $30,000 required distribution, we now have a $63,000 required distribution. And instead of having, about $900,000 in tax-free, we only have about $179,000, and we have about $1.6 that's in tax deferred, okay? And now at this case, now at this time at 72, now basically forever, we're gonna have this huge RMD coming out. So look what happens here over time. 80,000, 94,000, 103,000. This is only the RMD that's coming out that we're using, that we're not even going to need all this money for this client at this point. So this is just a bunch of taxes that's going to come out that we don't really necessarily even need all this money at this point in the future, right? So we really want to avoid that. So let me go back to do a quick comparison here so we can look at it one more time back to back. So if we look at this case, what we're going to see here, if we do the conversions, is basically we're going to have some RMDs, but they're going to be a lot smaller, and we need some money to live off of anyway, so we could just use that to spend. But by the time we're 84, now we have no RMD forever, right? RMDs are done, okay? Everything here is in tax-free in this particular case if we follow the schedule, all right? So by the time we're 83, 84, everything, really about 83 here, we're going to have everything in a tax-free account, 100% Roth IRA, no more RMDs forever, okay? This is if we do the 12% bracket. Something else we can do is look at what if we do the next bracket up and we go to 22, okay? So the tax-adjusted wealth is actually less, okay? This is expected to actually be a worst-case scenario, so I probably wouldn't recommend this potentially in this situation. But at the same time, if you look at the tax map here, by the time this client is 71, if we follow this strategy, we're going to have everything to tax-free by the time the client is 71. So when I look at the world right now, and when we look at what's going on in politics, it's pretty obvious that one party is pushing for lower taxes, the other party is pushing for much higher taxes. So if you're worried about taxes increasing in the future, you may want to consider something like this that's a little bit more aggressive on our conversion strategy. But what we'd be looking at here is we could get basically the whole tax deferred account, the whole 401k, IRA, whatever it is, we can get the whole account over to tax-free by 2027, okay? And if you look at our current tax plan, unless we get a reversal, which it doesn't look like we will, if we get a Democratic president and a Republican Congress, I doubt we're going to get things switched. So our current tax plan is slated to stay in place until about 2025, okay? And after 2025, it's going to go back. So basically, we have these next 5 years to take advantage of our low tax rates before they potentially roll back to what they were before. So if you're somebody that is basically, let's say you're negative on taxes going up in the future, like you think taxes are going to go up in the future and you want to protect yourself against that, well, maybe in your case, you want to do a more aggressive conversion strategy. So in this case, we can get everything converted by the time you are 70. So then, by the time you're 71, essentially, you have no more money here in tax deferred. Everything's out of your IRAs, and then everything is in your Roth account at this point. So now, basically for the rest of your life, you're only going to be living off Social Security and distributions from your Roth account, right? So now what your tax situation is going to look like in the future if we go back to here, let's go to our tax map. And let's go to our proposed plan here. We're going to go from this plan to a plan that looks a little bit more like this. So we're going to raise taxes early, okay? So our effective rate here will be about 15% federal and 5.2% state. This is, I think, North Carolina that we're using. But then once our primary client hits basically 71, we have no taxes anymore for the rest of their life, okay? So I know one of the questions was, about tax efficient distribution strategy, right? And that's important, okay? That is very important. But I think what's more important is to look at, is there opportunity for us to do some tax planning and to look at something like a partial Roth conversion strategy for you in your early years of retirement. And then by the time we get to later retirement, then we can get you to a Roth account, which then your distribution strategy becomes a lot easier to deal with because it's just all coming out of your Roth account, right? But if, along the way, we are going to have to distribute from accounts. That's going to be part of it. So let's go back to what I was mentioning here. If we go back here to our distribution schedule, as you can see, regardless, we're going to have some income from your taxable account, right? So if you have a brokerage account, we have stocks to sell, mutual funds to sell. What we'd have to do is go through individually, look at your stocks, look at your funds, see where you had some gains, maybe some losses. We would try to net out those to get our capital gains as low as possible. And then once we sold off what we need to sell off from here, like in this case, in the third year, we're going to use a little bit here from our tax deferred, a little bit from our brokerage, our taxable account, and then we're going to have a little bit from our tax deferred. So then we would go to our tax deferred account like our IRA, and we look at our funds there and figure out what do we want to sell, what's appreciated the most, what do we want to sell to rebalance, and then we rebalance the whole account, from there. That's how we would do that, okay? Take one step back here and let's just look at a 12% situation. So if you look at this case, we're going to have a little bit more of a mix of where we're going to pull from accounts. So in this case, taxable and then tax deferred. And in this case, a little bit, again, taxable and tax deferred. Depending on your situation, it may make more sense to look at a strategy where we take a look at all your accounts together. Like in this case, it actually brings we'd actually have more money by following what's called a pro rata strategy, okay? So we can increase your outcome and have a better outcome, but now we're looking a little bit more fancy, okay? So we're still going to do our conversions here, right? These are our conversions each year. But once we start drawing, as you can see here, by 2024, we're going to have a little bit of taxable money, a little bit of tax deferred, and a little bit of tax free. So in this case, what we're trying to do is just keep this client in the lowest possible tax bracket while converting the most money over to Roth that we can. So these are the buckets here that we're going to be pulling from: income from taxable, income from tax deferred, and income from tax free. So each year, we're going to have a little bit more variability in where we pull from. And in all honesty, how this particular setup is done right now is based on our current tax plan staying in place until 2025. And then 2026, it goes back to what we had prior to the TCJA. If we have a new tax plan, then this will have to be updated, right? So here's the thing is, we can really lay this out, but no matter what, we're still going to have to look at this year to year and make sure we're optimizing for taxes each year. So in this case, for 2025, we'd have, 38,325 from tax deferred, and then we would have 22,675 from our tax free. So we're drawing a little bit from our pre-tax account and a little bit from a Roth account. As we get down here, down below, eventually we're going to get to 100% drawing from Roth account, which will basically mean no taxes in the future. But it can get a little technical here, right? So let me pause here again. And see if there's any questions on this. I'm going to check the questions, see if anybody's responded actually. So is this making sense? Okay. And this is why I'm saying, you guys, if you're watching this and you have a situation where you have at least a few $100,000 and you have different types of accounts, you really want to take the time to get a tax efficient withdrawal strategy put into place, because as you can see, like I just demonstrated, it could be worth hundreds of thousands of dollars for you over your retirement time frame. Okay. So obviously you're going to have to pay for some help. Okay. You're going to pay for some guidance and advice. But if you're paying for advice and you're getting more return from the tax savings or from the investment strategy than you are from what you're paying, then that's called an investment. It's not a cost anymore. Okay. So doing this yourself can be a little bit technical. So I want to make sure that you're getting things done by somebody who knows what they're doing. Okay. So let's see if there's any questions here that will come up. Let me pause for a second. Let me take this out of here. All right. Okay. So Lois asked, how does one transfer long-term dividend stocks from an IRA to a brokerage account? Essentially, Lois, you would just distribute from the account. I mean, pretty much. You would sell the stock, distribute the cash, put that in your brokerage account. You know, that's pretty much what you would do there. Pretty straight up. Okay, so let's look at Laura's question here. Laura asked, at 72 and having $1 million in a Roth account, would it be so bad to keep a 70-30 stock bond ratio at that age as the Roth continues to grow and no heirs to worry about? Not necessarily, okay? Not necessarily. There's a lot of interesting research coming out. There's an article that just came out recently from JP Morgan that, actually, let me pull it up. I actually have it up here. Let me pull this up here because I think this will be useful for you. Let's talk about this for a second. So JP Morgan just published this article, I guess it was this Friday, okay? So JP Morgan is cutting their 60-40 outlook, and so they're estimating a 60-40 will earn just 4.2%, down from 5.4% in the coming years, according to them. So your question, your question about should you go to 70-30, this is something that's going to get a whole lot more interesting because we may need to look at other sorts of asset classes to increase income and increase the returns of our portfolios. The traditional 60-40 may not, work 10 years from now. So I don't necessarily think the 70-30 is necessarily bad, but what you want to consider, Laura, is that if you have a 70-30, 70% equities, 30% fixed income versus a 40% equities, 60% fixed income, you're going to have a lot more volatility, right? You could have longer periods where your account goes down 20, 35%. That's possible when you have that high of an allocation. So the way I like to do it is essentially breaking it up in segments, okay? So we're going to keep different segments of your portfolio for different time periods at different risk levels. So money you need the next year or two, we're going to keep that money very safe. Money we don't need for 5, 10, 15 years or more, we can invest that more aggressively and at a higher level of a equity portion the further away the money is. Okay, so I think that's definitely possible. All right. Tamara asked, do financial advisors with companies that Merrill Lynch provides advice? Not that I've seen. When you're working with a big broker dealer, okay, so any of these big guys, okay, so the Merrill Lynch's, Edward Jones, who else can we think of here? I don't know, any of those big guys like that. They are brokers. Okay, this is what you have to understand. Like there's brokers and then there's investment advisors, right? Brokers are really working for their company's interest first, and they operate under suitability standard, and they are not providing any sort of tax guidance of any sort. Okay, when you work with a fiduciary, an independent financial advisor, a registered investment advisor like Keep It Simple Financial Planning, we are able to provide tax planning and tax guidance because we operate under the fiduciary standard and as an investment advisor. So we are allowed to include that in, and so this is where we have an advantage over the big guys because we can really dive into this. So that's generally going to be a no from the big cases. What you're generally going to get is see your tax professional for that. And so they won't include strategies around distributions, Roth conversions, things like that I've seen. I haven't seen any of them provide that yet. They always say to partner with your CPA, but then your problem is you're dealing with kind of two separate things. Your CPA is looking at one thing, your financial advisor is looking at another thing. Nobody's looking at the comprehensive situation together, okay? And then if you start layering in things on top of that, like when you take your pensions, when you take your Social Securities, those type of things, you're really just missing out on having an optimized plan by working with somebody that only does investments for you, okay? And they may be good at investments, but I think investments are one piece of the puzzle. So really good question though, and I think that comes up quite a bit. All right, so let's see what we got for other questions here. So Dick asked, did I factor in this case multiple pensions and Social Securities that can affect your conversion amount? So in this case, yes, Dick, I included 2 Social Securities, right? So I did not include pensions though. So pensions can be another piece of the puzzle. So let's go back and talk about that for a second here. So let me go back to my thing here. Okay. So in this case, we have the clients, we have the primary client delaying it till 70, right? So, and this is a good thing in this case, because if we delay the primary client till 70, he has a higher benefit, he or she has a higher benefit anyways. Well, now we don't have this income coming in to fill up our floor, right? So remember our floor we talked about, like that 0% bracket, then the 10% to 12%. Well, if we have, 2,500 times 12, which is, I think, like, let's see, 2,500. So that's 30,000 a year. So if we have 30,000 a year just coming from our Social Security, up to 85% of that can be taxed. So that can be included in taxable income. So if we don't have this coming in, we can now convert more over in those early years. So let's see what this would look like if we took the primary at 62, and then we also took the secondary at 62, like we're saying here. Okay. Hopefully this updates for me. Let me just double check this is actually doing what I want it to do. Yes. Okay, perfect. All right. So in this case, so as you can see, by taking Social Security early, we've now gone down from about $250,000 plus in tax-adjusted wealth to 190. Okay, because we weren't able to convert over as much, right? And now we're not getting everything converted over until 85. Before it was 83. So it's going to take us longer to convert over. And if you look here, in the early years, we're converting in the neighborhood of 90,000, 96,000, 96,000, somewhere in that range. Now, because of the other income, we're only converting 76. So it's going to take us longer now to get everything converted over to the tax-free. So definitely, Dick, I did include that in our situation here. And so this is where, when it comes to optimizing a plan, this is where you have to put in so many variables, right? And this is where I really have trouble telling people like, oh, go find this online calculator and that online calculator, right? Because there's nothing that I know that's not a professional level tool that will allow you to integrate. And we only talked about Social Security, so let's add another pension or two. I have clients sometimes that have 3 or 4 pensions, that can all be taken at different times. So when you integrate all of these pieces of the puzzle together, it can become so obvious that if you just tried to do this on your own, you probably wouldn't have put it together as well as somebody who does this professionally. And that's really, I would love to be able to tell you just go do this on your own, but it's just when you're coming to retirement, and you're looking at big numbers like 400,000, 500,000 in savings, or 2 million in savings, the return you can get by getting your tax planning strategy right, by getting your investment strategy right, and your distribution strategy right, is in the 6 figures or more pretty easily many times. Okay, so to answer Dick's question, yes, that was being taken into account. Okay, so, let me go back one second. I got a couple more questions here. Another good question. Dick Lark, how were the conversion taxes being paid? Conversion taxes being paid, Dick, are out of our taxable account. So generally, we want to keep aside cash to pay that. We don't generally want to take out more money from our IRA to pay taxes because we want to convert from our IRAs up to the top of the tax bracket we're going to go to. So in this case, we're talking about 12 or 22. And then we're going to use money from our cash or our brokerage that's non-retirement money to pay those taxes down the road. Okay. So Tammy asks, my wife and I are 56, planning to retire at 57. How about we schedule a review of our portfolio with you? Great job on the taxes, as this is our biggest concern right now. Perfect. So I'm going to talk about that. So I'm going to put this up. If you want to schedule a call with me for review, we offer a complimentary retirement strategy call where we will review your situation with you and really help you outline a game plan and let you know what your biggest opportunities are. Obviously, I can't do a full plan with you like I'm going through today, but we can talk about if you look like a good candidate for what we talked about today, and potentially looking at a strategy would benefit you. So if you want to schedule a call, Tammy, you'd go to keepitsimplefinancial.com/talk. Okay. So anybody can do that, and that is complimentary for the first call. And then if it makes sense to work together, we'll talk about that, and we can talk and we go from there. Okay. So let me go back here with a couple more questions. Okay. So this one looks a little more complicated. All right. So hopefully I can make sense of this here. Pamela asked, redistribute IRA once you're retired, your tax bracket will be lower. Or B, if you think tax brackets will be going up in 2026, then redistribute IRA over 7 years to take advantage of the low taxes from present to 2026. So good question, right? So this is a good question. And, Pamela, neither you or I or, anybody except the man above is going to know exactly what's going to happen with taxes. But this is why it's so important to work with somebody who can really help you with your strategy. Because in all honesty, we can lay out a game plan like we talked about from now until 85 or 83 for this particular client. But the reality is we're going to have to review this every single year and then optimize for whatever the heck Washington decides they want to do or whatever the voters decide to vote for. And we're going to optimize, right? So to me, it doesn't really matter who's in office. What matters is how we're going to take what's available to us from a strategy perspective and how we're going to squeeze every last drop out of that for you, our client, to make sure that you have a good game plan and you're doing the best you can regardless of what's going on. But to your part B, I personally am really emphasizing for clients, let's take advantage of now to 2026 or now to 2025, and let's be a little more aggressive on our conversions, even if it doesn't quite make total sense. But if we can get more money to Roth account, at least we know we're setting that money aside. And if we go back to what tax brackets were before, let's go back to just 1 second here. If we go back to what tax brackets were before, you got to remember something that, so currently, we have, let me make this a little bit bigger here. Currently, we have 12%, the 10% bracket, the 12% bracket, the 22 and the 24, as you see on the left side there, okay? This was from the TCJA. This is from the Trump administration tax plan. Prior to this, it was 15, 25, and 28, okay? So what Biden has said is that he's not going to raise taxes on anybody making above $400,000 per year, but he also said that he's going to eliminate the tax cuts, okay? So again, we don't know what's going to happen, but let's say we do go back from 12 to 15, from 22 to 25, and from 24 to 28. Well, if you look at it today, we can be converting up into the 24% bracket and still be 1% lower than what's going to happen if we go back to what it was previous at the 25, right? So hopefully that makes sense. But, this thing, there's just so much, oops, I don't know how that happened. Sorry about that. There's so much variability right now in the market that it's like, we don't really know exactly what's going to happen. But me personally, I like the idea of being more aggressive today, because even if we go to 22 or 24, we're still going to be better off than if the 22 goes to 25 later, right? So hopefully that makes sense. But to your question, I personally think consider being aggressive. But again, this is a year-by-year decision. And in all honesty, I think taxes are going to go up in the future, personally. But maybe you don't. If you feel the other way, then maybe you want to continue to defer and wait. But I like to, I'm a little bit more, I'm positive on long-term market returns, but I'm negative on long-term taxes as far as taxes increasing, right? So I hope that answers your question there. Let's see here. All right. Okay. So let me read through this here. Okay. So William Gates, Bill Gates. I'm wondering if you're the real Microsoft Bill Gates. No, probably not. William Gates. You're looking for a financial advisor. My 401k plan has about $800,000. What is the monthly fee? Most people will not answer that question. Also, we have some investment properties like to sell in our area. Buy something closer. I've been hearing that we don't have much time to sell and then purchase another property. It might be 90 days without paying a nice chunk of taxes. Okay, so a couple things there. So to your property question, there has been discussions of getting rid of step up in basis when properties get transferred over to, inherited, and then also eliminating that capital gains exemption. So right now, if you're single and you sell a primary home, you can get a $250,000 exemption where $250,000 of gain is tax-free for a single person, and that's doubled to $500,000 for a married person. That's talking about going away in this new tax plan if it's a Biden tax plan. So there's multiple things here where if I were you, I'd want to be a little bit more aggressive when it comes to planning for taxes. As far as monthly fee, our fees are published on our website, William. So the first $600,000, we charge 1% on that management. And then after $600,000, we go down to 0.7%. And that would be up to the next $2 million at that point. So to calculate that monthly, I can use my calculator. I'd be happy to do that with you. So if you want to schedule a call with me, I'll break it down and tell you exactly what it would be. I don't want to do that here. It's not really a good use of time. I have no problem sharing that with you, though. If you say people won't tell you that, I mean, I'm happy to do that with you. Let's see. Okay, so ET asked a question here. What about putting money into life insurance and then taking tax-free withdrawals once in retirement? LURP, so to speak. If you already covered this, just ignore. I don't really like the strategy, to be honest, because you have to put a bunch of money in these cash value policies and whole life policies, and if you keep them for like 30 years, this strategy works out. It can work out well. But I personally don't like it. I personally would rather keep my money clean. I'd rather keep it outside of these strategies. This type of strategy is if people are going to have problems with the estate tax exemption. Right now it's about $11 million. So if you're going to go over $11 million, then let's get fancy with insurance strategies. Outside of that, I generally don't like them too much. I'm more of a fan of getting money to Roths and getting that tax-free income personally. But I don't sell insurance, so I don't have an incentive to make money off these things either. So that could be another part of the equation there. All right. Thank you, Jason. My name is Bill. So it is Bill Gates. Okay, everybody, we have Bill Gates in this group. This is wonderful. Okay, so those are the questions, folks. Those are the ones we had answered there today. I'm just going to go to this. So hopefully you found this insightful. This is a type of planning that I truly believe every one of you should go through. Okay, we offer multiple different programs if you'd like some help mapping this stuff out. And starting in 2021, we're going to offer a little bit more of a simplified version. But for right now, I'm working with you personally on this, and I'll be hiring probably some new advisors going into 2021 to help provide more help to more people. But if you would like to schedule a call, you go to keepitsimplefinancial.com/talk, and there you'll find my calendar page. And then once you fill out and select an appointment, you'll be forwarded to another page where we'll be asking you for a little bit of information to help us better prepare for our call. Very simple, very straightforward, no cost, no gotchas. We'll spend about 45 minutes to an hour really digging into your overall financial situation, your retirement situations. I'll ask you questions. I'll learn from you what's on your mind. And then we'll map out kind of the big, highest level things that you need to do, okay? And if those are things that you need my help with because it's above your skill set, then I can talk to you about that and we can discuss with you what that would look like. And if there's a better solution, then I'll direct you to a better solution for you for now. And there's about 30% of people I talk to is just not a good fit, and I just send them out to other resources. But for those that we can help, our goal is to provide such an impact that you are happy to work with us and pay our fee, because the amount of advice and guidance we're giving you is going to return multiples over what you are paying for services. So the services are charged based on complexity or based on assets under management. So we're happy to discuss that with you. Again, we do everything in writing with us. Everything's black and white. We are fiduciaries, and we do everything we can to be full disclosure and get that all on the table, because we don't want to have you come 5 years later and say, what was I paying again? We want to get on the same page with you from day one, so that fees aren't a part of our discussion. It's really about your life, your goals, what you want to achieve, and how to maximize and optimize your resources to give you the best retirement plan, okay? So I'm going to continue to talk about this withdrawal strategy stuff, I think, for a few weeks. We'll dig into some other things. I'll look at some questions that you had as well if there's some specific things. And if you want to be a case study, go ahead and send me an email, send me a message, and we'll talk about if you'd be a good fit for that. Other than that, folks, I appreciate you so much watching. I appreciate you so much tuning in. Hopefully I'm providing you value and that you're learning something from these workshops. I really do appreciate your attention. And if you have any questions, reach out. Okay, schedule a call. We'd love to chat with you. And whether it's getting ready for the end of 2020, or if you want to make 2021 the best year ever and recover from this coronavirus, get things on track, and get a plan in place so that if you are hit by something like the coronavirus in the future, like it just blows your world apart with the job loss or whatever, like we're going on right now, those are things that I want everybody to have a game plan for, and I'm passionate about, okay? We run a business, we charge for our services, but I would love to help you. I think we're very reasonably priced, and I think the value we provide is much higher than the average firm, okay? So please, if you're interested, reach out, keepitsimplefinancial.com/talk. And I think that'll be it for today. I'm going to answer one more question because Sean asked it, and I think it's a good question. How are we paid? Sean, we have two ways. If we're managing money, we generally deduct from the assets. Or if we're just providing advice and we're not managing money, then you just write a check. You pay out of cash flow. We can either charge monthly, quarterly, or just by the project if you want to do a project together. So it's flat fee advice or asset management for a fee. Those are the two ways we do it. Hopefully that's straightforward enough for you folks. Have a great day. I appreciate you so much, and we'll talk to you next time. All right, bye-bye now.